is a financial statement? A financial statement is a combination of statements combined in one. The point of a financial statement is to show you in a matter of seconds how your business is performing. For a specific period of time, their income statement shows a company's turnover, operational expenses, and profitability. The income statement shows the company's expenses and profits in order to determine whether the company is profitable or not. The balance sheet shows an entitlement's assets, liabilities, and equity at the moment of its admission. Sales, sales costs, net profit, operational profit, interest, paid taxes, net profit, and profit to total sales are all included in the income statement. Other non-operational income expenses, such as taxes, are realized, leaving the company with a net profit or loss. The income statement summarizes the company's performance over time by showing sales and revenue. Revenue is the income or revenue that the company receives from the sales or goods and services. Once you figure out which accounting methods are best for your business, it's easy to double-check the data on the income statement. These financial statements give you information about various aspects of your company's financial health. The total amount you're looking at is listed on a line or line item on each statement. Companies produce annual accounts to provide information on their financial health and most recent results. They are one of the most important methods of providing financial information about a business to external parties, as well as one of the most important components of business information. Annual financial statements are designed to reflect a company's financial status to investors, potential investors, analysts, and other interested parties as precisely as possible. Financial statements are reports that include financial information on an entitlement over a specified time period, including assets, liabilities, equity, income, expenses, shareholder contributions, cash flows, and other associated data. The income statement, the balance sheet, and the cash flow statement, as well as the fourth retained earnings statement, are the three main financial statements of a company that are in accordance with GAAP, or Generally Accepted Accounting Principles, and they are added together to give a report to creditors and investors. The annual accounts must be audited by an independent auditor every year and are included in the annual report, among other things, to comprehend how the current financial performance relates to the previous period. The financial statements are provided in two comparative periods. There are 5 sorts of financial statements that a person is prepared to submit according on IAS. 1. Allowance in US GAAP are the same in financial statements prepared in accordance with IFRS. Financial accounting information is transmitted in standardized reports. The basic financial statements of a company include 1. A statement of financial condition, 2. An income statement, 3. A cash flow statement, and 4. A statement of changes in shareholder equity and income. A balance sheet shows assets and liabilities. 5. Or, in the case of companies, shareholders' equity at a given time. The balance sheet is the most important part of an accounting equation because it shows a company's financial resources and claims them as liabilities to the owner. The balance sheet is a financial statement that shows the assets, liabilities, and equity of a corporation. The balance sheet is considered to reflect the financial position and condition, whereas other statements are stated to show the results of operations. The overall goal of financial statements is to give users, the company's investors and creditors, additional information about the company's financial situation. The necessary financial data is organized and presented in an easy-to-understand manner. The basic balance sheet analysis is offered for reading and serves as a foundation for analysts to comprehend other data obtained throughout financial report study. When discussing financial statements in this brochure, keep in mind that they are all interrelated. Investors, lenders, and sellers can use financial reporting to analyze the risk of collaborating with your company. The basic metrics for analyzing a company's leverage, liquidity, efficiency, profitability, and debt coverage are covered in this handbook. A consolidated financial statement is a set of financial statements prepared in accordance with International Accounting Standard 27, Consolidated Separate Financial Statements, or International Financial Reporting Standard 10, for a group of assets, liabilities, equity, income, expenses, and cash flow of a parent company. Consensus financial statement. The accrual method is used to create a cash flow statement. This is because a company's profit and loss account, according to this accounting technique, includes money that the company earns or does not receive, as well as expenses that it incurs but does not pay. The cash flow statement shows changes in dollar quantities at a specific point in time. The income statement is a period with the balance sheet in a single moment. Cash flow statements cut down the study of operations, investments, and financing by showing how changes in earnings affect cash equivalents. In essence, the financial statements resemble a reconciliation of a bird's-eye perspective of a bridge, with retained earnings appearing in two balance sheets. The first section of the cash flow statement examines a company's cash flow from its net income or loss. This section of the cash flow statement reconciles the net income stated in the income statement with the actual cash flow received and used for the company's operating activities in most cases. Non-cash items such as increased depreciation and amortization, as well as money used for other operating assets and liabilities, are adjusted to achieve this. Thanks for watching. See you next week.